SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
In this session, we are having four presentations. The first by Amra Balic, Managing Director and Head of the Investment Stewardship Team at BlackRock, Europe and Middle East Asia. I'm sure that Amra will tell us not only about the way in which in practice, in which way in practice this stewardship of remuneration, corporate governance is brought into the companies they invest in for the benefit of the goals of their clients, but also, maybe point at some of the problems in measuring, in implementing those criteria, which probably is one of the most interesting parts that we would like to hear about. Then we turn into a more theoretical exercise by María Gutiérrez and her colleagues from Universidad Carlos III of Madrid. I would say that this is one of these very lucky examples of one of those very rare occasions that we economists have to be able to carry on a quasi-natural experiment. In this case, one that helps us analyze what the effects might be of bringing some of the stakeholders, labor force, into the boards and see what might be the result and how it would compare with other ways of doing it. That just because they have had the good luck of finding a country in which, by law, there is a number of employees that bring up the obligation for companies to incorporate representatives in the board. Then we have the third person, Patricia Jackson, from the SMBC Nikko Capital Markets, which will give us, it would be also a good opportunity for us hearing from someone who has been able to bring in her own experience to be able to draw from that some of the challenges for boards associated with executive compensation, issues like diversity and incentives, etc. And then, last but not least, Juan Pedro Gómez, a professor at the IE Business School, with his co-authors, who are presenting a very interesting paper also on peer versus pure benchmarks in one of these areas of compensation, in particular that of mutual fund managers. And the interesting part of it is how, aside from all the conclusion results, the fact that they have been able to challenge some of the sort of well-established practices or policy recommendations of some of the most significant regulators around the world. I mean, there is a lot more that I could say about that, but I think that I will keep some of the thoughts for myself for the end of the session, and just remind you, please use the chat button to be able to ask questions to the panelists. Okay. So now, the first place I'm going to pass this on to Amra Balic. Please, Amra, the floor is yours.
Hi, good afternoon. And first of all, thank you so much for inviting me to join this event today. I'm going to spend next about 20 minutes talking about how BlackRock conducts our stewardship activities, particularly when it comes to climate. Dragana has been very kind to help me here in moving through the slides. So before we move into the next slide, let me just give you a little bit of introduction to the function that I represent here today. So I'm head of BlackRock Investment Stewardship Team covering Europe, Middle East, and Africa. We are a global team with regional presence. What that means in practice is the team is really spread through throughout the globe, starting from Sydney to Tokyo, Hong Kong, Singapore, Amsterdam, Frankfurt, literally across the globe. I think the importance of this point is because it gives us an opportunity to work with companies, to engage with companies on the topics that are relevant for them within their own context, within their own markets, within their own regions, and often in their own language. The team is focusing on broadly 4 areas. Dragana, can we please move to slide number 2? So what do we do on day-to-day basis? You can see here that there are 4 broad areas. Engagement is really simply conversation. I get often asked, Amra, you talk about engagement. What is engagement? What's the definition of engagement? And I would say that the best definition of engagement is simply a dialogue or conversation that we enter in with companies to address topics that we believe are relevant from the long-term perspective and can and will potentially have an impact on the performance on companies that we are invested in on behalf of our clients. We conduct a lot of engagements every year. You will see in one of the further slides that we have had more than 3,500 conversations with companies in the previous reporting period, which is year 2020. And that covers more than 2,000 companies. In terms of what is discussed in these engagements, we prioritize based on what we think is materially important for company success. But when I think about our priorities, there can be broadly grouped in 5 categories. First one is corporate governance, and I think this is not going to be surprising to any of us on this call. Board quality of the board overall, independence of the board of directors, diversity of the board, and how the board influences diversity further down through the organization is a key in terms of our conversations and how we think about the work of the board and us as an investor and the influence that we have as an investor. One point that I want to leave with this group is why the board is important for investors. Nominating and electing directors across the world is a key shareholder right that we have. So why do we take it seriously? Because that electing rather than nominating, to be precise, electing directors to the boards gives us an opportunity also to vote against board directors' election or re-election in those cases where we feel that the companies are making slow progress or the progress is missing year on year. The second priority is around executive pay. It's a topic that I know is very high on the agenda of this particular event, or as we like to call it, incentives that drive behavior. I would say in comparison to other regions, my team here probably spends more time talking about executive pay than in many other countries, or certainly the other 2 regions. What this means in practice is a say on pay or vote on pay is now well present across Europe. I think Shareholder Rights Directive has put it on the agenda even of those countries where there was not mandatory say on pay. So just this year, I can tell you that we have seen increased number of say on pay votes, not in terms of outcome, i.e. how we voted for or against, but simple number of the agenda items on pay that we have voted on has increased by about 30% as a result of implementation of Shareholder Rights Directive. A third priority is basically around climate and how we engage with companies on climate and other natural capital related issues. We spend a lot of time really thinking about climate as an investment risk. Back in 2020, BlackRock has come out in January 2020 with a really strong message to companies and our clients, which is climate risk is an investment risk. And we have spent a substantial amount of time over the last almost 2 years now, fine-tuning our policies, providing greater and more in-depth research, which will support how we work with companies and how we move and invest on behalf of our clients, taking into account this really key element or key risk that we need to take into account in the investment process. Fourth priority is on strategy, purpose, and financial resilience. So we are looking at companies and looking how companies disclose information on their long-term strategy. What are they telling us? What are they doing? How that strategy is capturing their own purpose, but also the culture, which is so integral in developing on purpose, an integral part also in how companies are working on delivering their long-term strategy. And then last but not least, and certainly the priority that has become much more tangible, much more visible over the last couple of years, which I'm going to go as far as to say COVID years, is around company impact on people, human capital, how companies are working with their both internal and external stakeholders, and how their relationships with their stakeholders has impacted their strategy in the short, medium, and long term. But going back to a slide number 2, that's really around our engagements and topics that we cover in our engagement. Second area of our activities is around voting. I would probably argue, and I suspect many of you will also agree, that voting is the most visible area of our work. Dragan, I'm still actually on slide number 2. So if we can go back to 2, so to cover briefly the 3 other areas. So on slide number 2, talking about voting, we vote on behalf of our clients. The shares that we vote on belong to asset owners or people whose money we manage. And it's really important to highlight that with our voting, we really try to reflect their long-term interests and what they are looking to achieve through investing with BlackRock. Third area is around market norms. Stewardship, sustainability, ESG, whichever term you use, has very much arrived on the radar screen of policymakers and regulators. Shareholder Rights Directive itself from 2019 has mandated all asset managers to be very clear in terms of how they conduct their stewardship activities on behalf of their own clients, but also how they work with companies on the key ESG related risks and also opportunities. And then last but not least, transparency. For us as an investor in the public market, disclosure and transparency is key to our ability to really talk to companies about any of these topics. So we are equally recognizing that as much as we ask others to be transparent about their own practices, about their own activities, it's important for us to provide transparency of how we work, what is important to us, how we work with the individual companies. And we have done that really by, for example, providing more granularity around some key vote decisions through our vote bulletins. And I'm more than happy for my colleagues here to receive more information and get a link to our website where we provide quite a detailed information about pretty much everything we do. So Dragan, if we can go to slide number 3 now. So one big development, I would say, both in terms of how we talk about our own activities, but also more specifically providing companies with clear indication what is important to us, has happened earlier this year, where not just that we have updated our own policies, voting policies and engagement guidelines, what we have done is we have provided clarity and specific points around what's changing for 2021. So the 4 areas here highlighted are the key, if you want, changes that we have made. Is further refinement of our expectations of boards and management. So the first one is around sustainability and how we ask boards to really be integral in shaping and monitoring what the management is doing when it comes to material sustainability factors in the company's business model. The second is around diversity, equity, and inclusion. We have very much further strengthened our focus on ethnic and gender diversity. And I think it's important here to highlight that we are cognizant in this work that conversation about diversity, but particularly when it comes to diversity beyond gender, can be very different depending which markets you are and companies in which market you are talking to. You don't need to go very far to realize that maybe what we can ask from companies in, let's say, UK or US could be simply completely against the law in the market such as France or even Northern Europe. So we do ask companies to, and the boards to be more clear around their own focus on ethnic and gender diversity. That conversation, disclosures really have to be considered within the market and regulatory context of the companies and the kind of world that they operate in. Last but not least is independence. Independence is probably one of the consistent key factor that we consider and see as critically important for investors, and have been for certainly as long as we have been talking about board effectiveness and our expectations when it comes to board and management. The second area is around shareholder proposals. For us sitting in Europe, I think shareholder proposals are still relatively small in numbers. We do see them more coming on specific topics such as climate, but shareholder proposals are still very present and a key tool that investors are using, for example, in the US. So what we've been doing, we have been very clear that based on our own data analysis internally, the shareholder proposals are increasingly important tool that we use in our stewardship toolbox in those cases where we feel that the management teams need a further encouragement, and also in some cases simply to recognize urgency around the topics such as climate. And we are therefore, or we have therefore been more supportive of the shareholder proposals where we felt that the companies can either accelerate or in some cases can maybe give a further positive signal to management team that are working on some of the climate related issues, but they need to clearly continue on the same journey. A third area is refining expectations for how companies manage climate risk. And this is really important in the context of transparency and disclosure. We have asked companies to disclose plans. We have seen companies coming up with their 2050 commitments, net zero commitments. But what we are saying is having a commitment towards net zero by 2050 in relation to global GHG emissions is really important. But companies need to also tell us how they're going to get to that point. So having plans, having clear steps that they will take in the short, medium, and long term is something that we have been asking companies to disclose. When it comes to how that disclosure is going to be delivered, if you want, by companies, we work with the two key reporting frameworks. One is TCFD, and the other one is actually has evolved even since our document that is being updated this year is in relation to SASB. We are very much supportive of the IFRS Foundation and the work in this space that has been announced recently, and we will continue to, first of all, be integral part of some of these conversations, but also continue to support global consistency as much as possible, recognizing or coming from the point of being a global investor. Another area which is, again, more common in the US, but I think it's nevertheless worth putting on this slide, is around political activities. Certainly this is relevant probably globally when it comes to trade associations and how companies are really, the link between what companies are saying externally when it comes to their climate commitments, strategies towards moving or getting to net zero by 2050 versus their memberships in different trade associations and supporting potentially trade associations that maybe could come across out of line with maybe what the companies are saying to their investors. And then last but not least is intensifying engagements on other environmental and social issues. The one that is the most obvious one, as I already mentioned, under 5 priorities, is around stakeholders. COVID has the most important legacy, I believe, of COVID is going to be continued focus on people, starting for companies with their own employees. We observe that the companies which have early on and continued to be very focused on the experience, if you want, at their employee level, are the companies that have come out of the crisis better positioned to tackle maybe labor shortages, etc., and are potentially more likely to be better placed for short, medium, and longer term success. We are also thinking about, again, going back to the point around diversity, equity, inclusion. We are also asking companies to simply explain to us how do they deal with some of these topics, recognizing that when it comes to S in ESG, if we think that the data quality, availability, consistency is still in progress, work in progress when it comes to climate, for example, we have a huge way to go when it comes to S-related issues. Consistency, availability. When we talk to S issues with companies, we find that companies are really pretty good in disclosing their own policies on diversity, equity, and inclusion, but measuring success, measuring progress, there is very little information. So we are calling for companies across industries and markets, again, thinking about some of these points from the perspective of what they can do given their own legal and regulatory framework to start making progress on disclosure of this information. Dragana, slide number 4. So this really gives you a bit more information, or probably gives you a bit more data around the conversations that we are having with companies and their boards and management teams. I mentioned these two numbers, big numbers, number of engagements, a number of companies that we can engage with over for the previous reporting period, which was June 2020 to June 2021. They are really presented here per each of the 5 priorities that I mentioned earlier. And you will see that some numbers clearly stick out: climate and natural capital, strategy, purpose, and financial resilience, and the board. I'm going to spend just a couple of minutes talking here about importance of board quality and effectiveness and how board fits into the engagement conversations around these 5 priorities. We have been very clear over the last 3 4 years that we are going to be taking or holding boards to account, or individual board members or committee members, when we see that companies are failing to make progress. So one big change, and I think maybe Dragana, we can probably move to the next slide, is where we have slide number 5, that you can see here how many directors we have voted against in the previous voting season. And each single vote here is directly linked to an area where we have potentially held directors to account for lack of progress, or, which is much more specific for Asia, where we have had concerns in relation to independence. So this is data for the 3 key, if you want, areas where we have had the greatest number of votes against. So in EMEA, that's about compensation. As you will recall, as I said earlier, we spend a lot of time talking to companies about pay. And it's maybe not surprising that the number of votes against when it comes to pay is the greatest in EMEA. Independence, the greatest number is around votes in Asia. Independence is really important for us as a minority, and I highlight this, we are always a minority investor. So independence is really important for us in Asia, given the typical ownership structure of companies that we invest in, and the very frequent presence of major or majority de facto shareholders to protect assets basically that are invested in these companies. And then last but not least, diversity is the key theme that we have voted or kind of taken into account. And I think important to highlight that in the US, this is the market where we really can talk about racial and ethnic diversity, because none of us would have missed developments over the last 18 months. And we are very, very strict and are open to companies asking about not just gender, but also ethnic and racial diversity, in that how that is taken into account in companies' own policies. I'm cognizant of time, and I said that I'll be talking about roughly 20 minutes. Dragana, maybe last slide, maybe narrowing it down to climate and how we have voted on climate shareholder proposals. The difference between Americas, EMEA, and Asia Pacific, it's not surprising to you that the largest number of votes is in the US. Probably, definitely in part is due to shareholder proposals, a number of shareholder proposals that we see in the US comparison to any other region, followed by EMEA and then Asia Pacific. That's when it comes to companies. And then how often we have been voting against directors where we have felt that the progress on climate is slow, or that the management team is maybe needs to be reminded of urgency with which I think the whole world, and I think COP26 and coming out of COP26, I think that message is loud and clear. Thank you.
Give now the floor to María Gutiérrez from Universidad Carlos III, talking about when employees have their say on capital structure.
Thank you so much for having me in this super interesting event, and I'm really honored to be in such company. And I'm going to present an ongoing project with two former students of mine who are now at Stockholm School of Economics. And the fact that they are there is very relevant because we use Swedish data for this study. So what is this about? Well, this is about what happens when employees have their say, okay? I would like to start being a little provocative here, because I think what we see so far is that the current approach to achieving ESG goals actually is like enlightened absolutism view, which means, you know, we are trying to do everything for the people, but nothing by the people. So, you know, this is a conversation among investors, among shareholders that is going on. And I mean, don't get me wrong, there may be very good reasons for keeping it like that. Okay, so, you know, you only need to go to Tirol, and he explains why we need to keep formal control rights with shareholders to have a well-functioning corporation. So I'm not saying that that's not the way to go, but you know, sometimes enlightened absolutism is followed by revolutions. So maybe we should be aware, or we should try to exploit or to consider what happens when you share control rights with other stakeholders. And in particular, in this paper, we discuss what happens when you invite employees to the table. So, of course, we are not the first one to study this topic, and in the literature, we find the discussion of different sources of employee control rights. So, probably the one that most people is familiar with is the literature on or the study of co-determination. You know, like in Germany, you have a dual board system, and in that case, employees actually get formal control rights, yes, and they have voting power. Then there is also the study of unionization. So unionization, although is not inside the company and it doesn't give workers voting rights, is a source of informal control rights, yes, because it increases the bargaining power of employees. And in our paper here, we are testing another source of power, another source of control rights, which is information. Okay, so what happens if we give employees access to more information. And we do this by exploiting the Swedish participation system, because in Sweden, employees get board seats, and these board seats don't really carry formal control rights, because they are always going to be a minority, as you will see when I explain a little bit more the setting. But they give employees access to board deliberations, to board discussions, to the board agenda. And what we find is that this is a source of power for employees, and we show you how they use it. Okay. So in the literature, there is a discussion of what happens when employees have more power inside the company, and the results, both at the theoretical and at the empirical end, are kind of unclear when it comes to whether this is going to have a first order impact on firm value. And this is because different effects may be at play. So we heard, actually, I think it was from Jose Manuel, but I think also from Jordi, that, banks must have long-term commitments with their employees, yes? But the problem is, how do you actually make a long-term contract enforceable? Yes, so the idea is that giving more power to the employees, you can ensure that this is a credible long-term contract, and then this may induce employees to invest more, yes, in firm-specific skills, and this may be good for total firm value. But on the other side, there are unclear effects about how you are going to monitor the managers when you have more employee power, and how you are going to make investment decisions. Okay, so on the one hand, you can think that there would be better information aggregation when employees have more to say, but also there are going to be more conflicts of interest. So overall impact is unclear, but we have more to say about how redistribution will happen, yes? So basically, employees, the theory, it tells you that employees will bargain for higher job security and higher salaries, okay? So, and this goes back to something also that Amra was saying, that, we want inclusion, we want diversity, is this what employees really want? Because maybe they just want more job safety and higher salaries. Yes, so we should take this into account when we are thinking about, what stakeholders really want at the firm level. This is the main effect that we will expect. Okay, and I will show you evidence consistent with this in our case. Also, shareholders may fight back when they see that employees are getting more power. And there are some studies showing that when there's more unionization, shareholders tend to increase leverage as a way to counteract the bargaining power of the unions. And also, they may change the compensation of managers, although the evidence here is very unclear, but I think that's something very interesting. And also, there may be interesting effects about alignment between different stakeholders. So we know that because they are risk averse and their claims are fixed, employees and debt holders may align in their interest, and they may there may be more safety for debt holders when employees are powerful, and this may lead to an increase in debt ratios. Okay, so this is more or less the theoretical framework that we have for this study. Now, what do we actually do? Well, the Swedish law allows unions of firms with more than 25 employees to appoint 2 board members that must be selected among the firm employees. Okay. So this is like a natural experiment, and what we do is we see around this 25 threshold, yes, so moving from 24 to 26 shouldn't have any impact on the firm, apart from introducing these employee representatives at the board. So we test this using a regression discontinuity design, and what we find is a very substantial impact. In particular, we find that there is a decrease in the debt to equity ratio of around 16%, and we test that this is really coming from a reduction in debt and not from a reduction in equity, you know. So we find an impact on interest expense, we find an impact on pledged assets, and also we observe an increase in a significant increase in the annual salary. Okay, now how is this happening? Because as I said before, employees are always going to be a minority in these firms. Also, these are small firms where, you know, basically the power is in the hands of the shareholders, and the shareholders control the board and, of course, the shareholders general meeting. So we claim that in this case, this doesn't have anything to do with co-determination. What the impact is coming from information. So basically, employees have access to more information when they are on the board, and they use this information strategically. To test this, we have results, different results for growth firms, which should be more difficult to value than mature firms, and also for high complexity firms versus low complexity firms. And what we find is that the impact is really happening in growth firms and in high complexity firms. Okay. So now it's interesting. I mean, this is Swedish data. So of course, probably all of you know that Sweden is characterized by high unionization, high collective agreement coverage, and a single tier board. So this is important to understand our results, and we exploit the 1987 Act on Board Representation for Employees in Private Firms. Okay. Now, the nice thing about Sweden, which is very different from Spain, is that they have all these super detailed and very accessible databases. So we actually have a database with the financial statements for all Swedish firms. So when we look at around the 25 threshold, if we keep it very, very close to 24 to 26 employees, we have over 14,000 firms, yes, which is super nice to test anything. And then if we extend the bandwidth, we have many more firms. Okay, so this is the equation that we run. Okay, this is our specification, and what we are mainly interested in is in this beta, which is telling you, is there a difference in leverage for the firms when they get representation, they get employee representation, and we control for, you know, the difference in the number of employees, and also the interaction effects. We also control for additional variables like size, profitability, growth, tangibility, and our cutoff is 25 employees. Okay, so we try to see this is regression discontinuity design. So we don't impose a formal model on the data. We let the data tell us which is the best approximation that can be made, and we try to adjust different polynomials. And what we see is that irrespectively of whether we use a 2-order polynomial or a 3-order polynomial, the best fit that the model offers, there is always a jump, okay, at the threshold, at the 25 threshold, a jump that implies that when you cross the threshold and you have employee representation, you are going to decrease the debt to equity ratio. Okay, so these are the graphical results. These are the quantitative results, and as you can see, depending on the type of bandwidth that we use and depending on the polynomial we use, the results are a little different, but they are always significant. And and important, yes, in economic significance. So I'm only showing you the results for the debt to equity ratio to keep this short, but we have results for all the other variables. So to keep it short and to the point, and to conclude now, basically what we do in this study is we use Swedish data to show that being on the board, even if this does not give you a lot of voting power, is a source of valuable information, and that the employees will use this will use this additional information to improve their bargaining position, to get higher salaries, and to reduce firm riskiness. And we test that this is really the case, that this is happening through this information channel. And we find that our results are stronger and more important for growth firms and for high complexity firms. That's it. Thank you very much. And I'm happy to have questions now or later.
Okay, thank you very much, Maria. So at this point, I have the pleasure of inviting Patricia Jackson, non-executive chairman of the SMBC Nikko Capital Markets, who will give us her thoughtful views on the executive compensation challenges for boards, diversity, incentives, and culture. Patricia, the floor is yours.
Well, thank you very much, and it's a pleasure to speak to this conference. I'm actually on 3 boards, portfolio, independent, non-executive director, but I need to stress that the views are those of mine alone. Dragana is going to move the slides forward for me because I've also had problems with the web. Thank you, Dragana. So the regulators have been intervening in remuneration structures quite intensively since the crisis, since the last financial crisis, and focusing really on how to influence culture. But the original interventions were all around the structure of the remuneration, really, the quantum of variable bonuses relative to fixed, the deferral periods, clawback, malus, and so on. But increasingly, over the years since the crisis, there has been a focus on non-structural elements, such as how to reflect culture and conduct, and now how to reflect diversity and inclusion. And I'm going to try and tackle some of these more nebulous issues from a board perspective. Dragana, if you could move forward, thanks. Thanks. So if you look at risk culture, it's absolutely essential that the board owns the risk culture, that the board sets the expectations, the board oversees the monitoring metrics, and has to really consider what drives culture. It's not enough just to look at the results of various surveys. The boards must consider the incentive structures in the round. Now, that isn't just remuneration and variable pay, it's also financial targets set for the business areas. If the financial targets aren't appropriate, they're not going to drive appropriate behavior. And you've only got to look at the effect in the crisis of the profit targets that have been set for the treasury operations of some of the most major banks. Having turned treasury into a profit center, the treasury behaved like a profit center and were holding huge quantities of low quality RMBS because it yielded more. So boards have got to think about the targets that are set. If very high targets are set for sales of particular products, the middle management will try and get the sales of those products. And we saw the effect of that in the UK with the mis-selling of payment protection insurance, which was very valuable to the banks and for some banks accounted for as much as 13% of their gross revenue. They set high targets, middle management set out to achieve those targets and effectively drove mis-selling. So I think boards have got to think about incentives in the round, not just pay, not just bonuses, but also the general incentive structure for the company. To understand the culture from a board isn't necessarily that easy. You're sitting at the top of the organization. So how do you get the information flowing up that tells you really what the culture is, what it's really like? You can set various monitoring metrics that will give you an indication, delays in dealing with audit findings, people not doing their training, turnover rates, etc. But you need to supplement that with other information. And I think focus group information is probably some of the most valuable, more valuable really than surveys. Boards are increasingly trying to get culture metrics into the balanced scorecards for senior executives. The challenge is, how do you include things that include the positive and not just the negative? It is quite easy to pick up on incidents, problems, and reflect that in overrides on remuneration. It's harder to get that general positive sense, and perhaps one way forward is 360-degree feedback around the individuals. Dragana, if you could move on to the next one. If you look at diversity, and this is diversity in the round, it's not just gender, it's ethnicity. This is a very large focus for boards, but here again, the question is how you achieve it. You can set targets for senior roles to be occupied, for example, by women, but how do you actually get the firm to deliver it? How do you look at that from the top of the organization? And I would argue you have to, as a board, through the REMCO, take an interest in recruitment. How is that being done? What sort of firms are being used as headhunters? Are you asking for balanced lists across men and women? But you can't just deal with it through hires. You've got to deal with it through promotions. If you can't get your stock of women promoted and developed up through the organization, you will never achieve the targets. And, or you won't in industries where women are underrepresented in any case at the senior levels, because you can't bring in enough. So you've got to focus on development. You've got to focus on whether the promotions are working right. And here again, feedback from the focus groups becomes really important to the boards. But what do people really think on the ground? Well-designed questionnaires can help. And then you've got to go back and think, what is it that's going wrong with promotions? You've got to monitor the data on rate of progression of men and women at different levels in the organization. So are they progressing at the same level, at the same rate? Or are women progressing more slowly? Are they hitting roadblocks? Trying actively to bring in people from a wider range of ethnic groups, sponsoring, for example, individuals to come in on internships, starting right at the bottom, but also looking all the way up at how you're hiring. How do you build this into an incentive structure? Tough, really tough, because you could set targets for heads of business lines that they've got to bring in a certain portion of women, or they've got to hit certain levels. But the problem is those women may not be available. With the best will in the world, it is extremely difficult to bring in senior female candidates in the capital markets. But really thinking about how you build those incentives, I think, is quite a challenge at the moment for the boards. If we could move on to the next one, Dragana. And then you get to ESG. Now, I think that the issue with ESG is that the companies are themselves still struggling with the targets they should set for the organization. So it's premature to start setting the targets through the incentives and REMCO. The difficulty with setting the targets is, I think, multifold. How do you understand the risks that you face? The models that we work off, VAR models, credit risk models, are built on the past. That they don't necessarily reflect the volatility we're going to see in the future. I'm convinced that we will see periods of Minsky moments when classes of assets suddenly get downgraded, like we saw with the RMBS and the crisis, that people will catch up with the fact that they haven't really fully reflected the future for that industry and the future profitability for a range of corporates. Information will change. The timescales over which companies will have to deal with it will change. And if those accelerate, we will get faster effects on downgrading and corporate worth. There are considerable challenges around stress testing, not just the data within the firms, but actually what scenarios are you going to use for the future, going back to this issue of uncertainty and volatility. This period will be far more volatile, I think, than the periods we've seen in the past. And how do you really set the business strategy as a board to reflect the green activities that you want to do? So, but avoiding greenwashing and so on. So I think that the challenges are that companies are setting targets for 2050, some earlier, for neutrality. But the challenge is, what are the short and medium term targets to get there? Now, everyone's looking at their exposures in banking to brown industries, but shouldn't you also be financing those brown industries to change? It's important for society that they do change, that they do transform, that they do build green activities. But how do you know that if you're funding them, even if the commitment is for a green project, that actually in effect that's where the funding's going? And I mentioned the issues around greenwashing. And so I think boards will get to linking these areas to incentives, but first of all, to financial incentives for the staff. But I think first of all, we've got to get the short and medium term targets right that will get us to 2050 or 2040 or whenever it is. If we could move to the next slide, Dragana. So overall, I think my message is that boards have got to really think about what they're trying to achieve across a broad front and look at the entire incentives and structure that they have within the firm to deliver it. There is absolutely no point in having positive words about culture at the top and then setting very hard, heavy targets on profitability on particular areas of the business and not monitoring what effect that is having on behavior. So I think that really is my message. Thank you.
Okay, thank you very much. Now let's get to the last part of this panel with Juan Pedro Gómez, professor at the IE Business School, who will present his paper, I would say provocative paper, entitled Peer versus Pure Benchmarks in the Compensation of Mutual Fund Managers.
Thank you very much. It's a pleasure to be here today with this distinguished panel, learning about this very interesting topic. I'm going to shift focus now, if you allow me. So thank you for the opportunity to present my work in talking about a topic which is common to both CEOs and portfolio managers compensation. My expertise lies more on portfolio managers. So that is what I'm going to be talking about, okay, in terms of compensation, benchmarking, and portfolio managers. Let me just say that this is joint work with Richard Evans, with Lily Ma, and with Yehuda Tan. So I'm going to give you a glimpse about the main questions, the main theoretical predictions, the data that we have, and the main results. I'm not going to go into detail with the tables because of in the interest of time, right? So the idea is benchmarking and incentives. This is a conference about executive compensation. It's about compensation. And this is a very long topic, I mean, a very old topic in terms of CEO compensation, the use of benchmarking. So when you compare the performance of a CEO and the remuneration of a CEO relative to peers, okay, or relative to a benchmark. Why do we do that? Well, this goes back to Holmstrom, for instance, and a Nobel Prize idea, if you want, where you want to reduce noise in the comparison when you are evaluating a manager by comparing the manager, the CEO, to a reasonable, justified group of peers. You are removing noise, undesirable, non-rewarding noise risk from the compensation and making it more efficient. And there is a long literature about that, both theoretical and empirical. And among the topics discussed in the CEO compensation literature and incentives relative to benchmarking is the question of the nature of the benchmark. That is, should the benchmark be a Standard & Poor's 500 index, like a market broad index, or should we actually choose a group of peers, managers, CEOs from similar companies to evaluate and compensate through relative performance evaluation this CEO? Well, now take these questions and let's take them to another important financial intermediation agent, which is mutual funds. We channel, billions of dollars, euros into the market. So the question here is, I'm going to compensate my manager. Am I going to do it relative to a benchmark? Well, there is, already quite extensive literature on that. And in principle, the premise, unlike in the CEO literature, is that there is not a good reason to benchmark managers, okay, unlike CEOs. They may actually affect adversely risk-taking incentives. It doesn't really motivate effort. Well, there's a literature on that. I've been contributing myself to that, showing that this negative aspect of benchmarking can be overcome once you limit the choice, the investment portfolio of the manager, right? Another discussion, also motivated by the SEC regulation, is whether the compensation relative to a benchmark should be of the fulcrum type, which means that you reward the bonus and the malus should be of similar proportion, or in the case, there should be a malus as well as a bonus, or it should be of the convex type, which, there is a bonus if you outperform the benchmark, but there is not a malus if you trail the benchmark, right? Well, it is interesting, however, to notice that in this discussion of benchmarking portfolio managers, there is no discussion about the nature of the benchmark. So should the benchmark for the manager be the S&P 500, for instance, or a Russell 2000 index, or should we actually pick a group of peer managers from funds in the same category and see how they have performed, and then compensate the manager relative to the performance of this peer group of funds, mutual funds? There's no discussion about that, and that is actually where we want to contribute. So let me bring in here two theoretical but mainly empirical myths that we try to confront and negate here relative to the compensation of portfolio managers. The first myth is that portfolio managers actually don't have incentive-based compensation. The typical way in which this has been modeled and tested in the literature is assuming that managers are compensated as a percentage of total net assets under management. So if you do well, flows come in, your portfolio becomes bigger, your fund becomes bigger, and since you receive a percentage of the funds under management, so does your compensation. Likewise, if it decreases, so does your compensation. Well, just here, this is a note from Elton, Grubel, and Brake. This is a quote from their famous paper 2003. Incentive fees are not widely used by mutual funds. In 1999, they mentioned that less than 2% of the funds in the sample actually use incentive fees. However, that is not true. In my previous work with mine and two of my co-authors in this paper, we show that mutual fund managers, when we look at the compensation of the actual individual, so we're going to the core of who is taking the decisions for management, for the portfolios. That is the actual manager. This is John Smith or Mary Smith, right? Well, these managers are compensated relative to performance in the 80% of the cases. And for the cases of assets under management, so compensation of individual portfolio managers based on assets under management is less than 20%. So this is the first myth that we have to actually cancel. Managers do receive explicit performance-based compensation. So the choice of the benchmark becomes relevant. The second myth is that if there is a benchmark in portfolio management evaluation or performance, that is of the market, or we call it pure kind. So if there is, everybody, when we buy, we invest in mutual funds, we look at the prospectus. And since 1993 in the US, the SEC requires the funds disclose this benchmark. So investors can actually gauge how much they are getting relative to the performance of the closest pure passive strategy or pure passive investment strategy. Okay. Well, the SEC actually opened a debate back in 93 as to whether this prospectus benchmark should be a pure benchmark, an S&P 500 type of benchmark, or whether funds should also disclose the performance of similar funds, that is, peers. Well, actually, they concluded that it should be only a pure benchmark. So the prospectus benchmark is always going to be a pure benchmark because the SEC actually forbids that funds disclose the performance of peers. Why is that? Well, the rationale is that the SEC rationale back then was that the fund could underperform a relevant market while nevertheless comparing favorably with its peers. So the idea is that funds may choose strategically what is the most favorable group of peers in order to make their performance look better. Okay, so they say, forget about that, only market benchmarks. However, when we zoom in and we look at the benchmarks in the compensation of that 80% of managers who receive explicit performance-based compensation, we find the following. We find that peers are used in isolation or jointly with pure benchmarks in over 70% of the funds. So it is not true, and this is per se a contribution of our paper, that funds, if they use performance-based compensation, is always tied compared to a pure market-wide benchmark. In 70% of the cases, there is also peer-based compensation. So the question then becomes, relevant. Why are they, both peer and pure? And does it matter for performance? Does it matter for risk taking? These are questions that have so far not been explored in portfolio delegation in the mutual fund industry. So why is this possible? Why has it not been studied before? Well, it is only since 2005 that the SEC requires mutual funds to disclose the actual compensation of the individual portfolio managers in the statement of additional information. So we're going to have two types of benchmarks for the same fund. On the one side, there's going to be a prospectus benchmark that investors are going to see when they invest in the fund. On the other side, the fund family or the advisory firm, which may be a different agent, is going to hire managers which are going to be taking the portfolio decisions for the fund, and they're going to choose the compensation benchmark. This compensation benchmark and the prospective benchmarks need not be the same. Actually, we find the following. When a compensation benchmark of the pure type, market-wide basis, is used, it almost always coincides with the prospectus benchmark. But keep in mind that in 70% of the cases, there is also a peer benchmark, which for sure is not going to coincide with the prospectus benchmark because the prospectus benchmark by law has to be a market-wide type of benchmark. So this is how we can study this question now. We can go deep into the incentives and in particular the nature of the compensation benchmark of portfolio managers due to this new regulation since 2005. Let me give you an example of what we find in this statement of additional information. By the way, this is open text, free text, which means that in order to get this data, we have to go through individually, one by one, these statements of additional information. They are not easily coded. So we have this first example here, Goldman Sachs Mid-Cap Value Fund. In this case, the benchmark used for the compensation of these managers are of the market type, in particular Russell 1000, Russell Mid-Cap, and Russell 2000, depending on whether we're talking about the compensation of a manager for a large, mid, or small cap value fund. Another example of the opposite nature, the peer-wise nature, will be the Marshall Mid-Cap Value Fund. In this case, each portfolio manager's performance is measured against the index set in the following table. And all of these indices are Lipper-based. Lipper takes the performance of a subset of funds in the same category, and then takes the performance of this as a peer measure, average peer measure of performance. So there will be two examples of market and peer and peer nature for the benchmarks. Okay, what are our questions? We're going to study for the first time the choice between these two types of benchmarks, peer versus peer, in the compensation of mutual fund managers, individual portfolio managers. We're going to see that theoretically, because actually there are no models comparing these two, so we develop our own model. And empirically, we're going to see how the use of peer versus peer benchmarks in managers' compensation affects managers' effort, fund activeness, ultimately how much risk on top of the benchmark the manager is taking, incentives and advisory fees, and risk-adjusted performance. Okay, and the last part, this is coming from the model. We're going to have predictions from the model that we take to the data. Outside the model, we want to answer the question, we want to offer some hints about what are the drivers of the choice between these two types of benchmarks. Okay, and we come out, with a conclusion, or we explore the heterogeneity in investor sophistication as well as fund family characteristics. So I'm not going to enter into the detail of the model in the interest of time, but basically what the model predicts, this is a model based on moral hazard and asymmetric information. Managers has to put some effort, which is not observable. And we're going to study what is the role of the nature of the benchmark in inducing more or less effort, unobservable effort, to this manager, okay? And then which one should be used. Well, the conclusion is that if we want to induce more effort, which is also going to come at the cost of higher tracking error volatility, higher residual risk relative to the benchmark, we should use peer-based compensation. And the idea is simple. It's similar to the insight that comes when we talk about keeping up with the Joneses preferences. If I'm looking at my consumption relative to my peers, I'm going to bring in my peers' consumption into my own decision. Likewise, when managers take their effort decision, if I'm comparing them relative to peers, which some of them are going to be compensated relative to also peer performance, but some of them relative to peer performance, I'm going to bring in that peer performance into implicitly my incentives, and that is going to, on the one side, leverage the incentives for outperformance. It's going to limit the manager's ability to undo incentives, which is one of the reasons why benchmarking was considered as inefficient in this literature, and it's going to increase incentives for active risk-taking. So as a consequence, more incentives, higher risk-taking is going to lead to outperformance. Part of this outperformance we show is going to be passed on to investors. It means that not only gross value, but also net of the compensation, investors will profit from peer-based benchmarking. What is empirically, what data do we use? So we have Morgan Stanley Direct Mutual Fund, Thomson Reuters. This is standard, and this is our contribution. We go to the SEC Edgar, to the prospectuses within that, the statement of additional information, and the ADB filings. And this is information that we manually extract, so it's very time consuming. The same polluter model is going to be US domestic equity funds from 2006 to 2012. So it's going to be slightly over 1,000 unique mutual funds across 153 fund families. So it's going to lead us to 7,000 5-year observations with compensation benchmarks. Again, these are not prospectus benchmarks. We also collect them, but that's easy because those are coded. These are compensation benchmarks of individual portfolio managers. The key variables are going to be peer and pure compensation benchmark indicator. Okay, peer is a market index like the S&P, and peer is going to be typically a Lipper index. Okay, and in our analysis, standard errors are adjusted for elasticity and cluster at the fund level. What do we get? I'm not going to bother you with tables. Okay, it's late in the last one presenting, so let me just go, into the results. Both peer and pure benchmarks are prevalent in the compensation contracts. So 21%, sorry, of the funds use peer benchmarks in isolation only. Okay, and the remaining 50%, they use both peer and pure. We also find something before we introduce any adjustment for risk interesting. Peer benchmark is harder to beat a pure benchmark. So it's more difficult for the manager to make an incentive if the manager has to beat his peers or her or his peers than if the manager has to beat market-wide. This is actually consistent with the idea that we said before that we get a higher kick of incentives when managers are compensated relative to peers. So comparing peer to peers, peer benchmark compensated funds indeed, as predicted by the model, exhibit greater portfolio activeness, and we have 3 measures for portfolio activeness. In the 3 cases, you'll see results in the paper. That is the case. We find that dollar-wise, they should receive more compensation, and they do. So the dollar compensation, not the compensation because we didn't observe portfolio managed compensation, but the dollar value of the management fee is higher when the manager is compensated relative to peers rather than peer. And they do have superior gross and net of fees performance as predicted by the model. In terms of determinants, we see that the use of peer benchmarks is more likely when the fund is catering to more sophisticated investors. For instance, is catering to investors whose management company also has as a client a hedge fund, or the average account is higher, denoting that it's people with more money, more skin into the game, more sophisticated, demanding more from managers. Also, the channel through which the fund is sold matters. When we are talking about direct sold funds without brokers, typically another measure of investor sophistication, we see that they are more likely to compensate their managers relative to peers and not to a pure benchmark. And families with greater incentives for competition. So families that want to instill higher competition among their managers rather than a cooperative culture. Okay, there are different ways to measure that, but we find that in those cases, that is when we see peer benchmark compensation. So it seems that, all this is consistent with the idea that theory-wise we show that these managers, when incentivized managers offer them a peer-based benchmark. And this is also consistent with features at the family as well as on the investor level. This, the main reason that we find for funds to use peer benchmark compensation is effort inducement is higher incentive at the expense of higher risk, but part of it goes to the investors. So the main conclusion, just to finish here, is that portfolio managers are not indifferent to the benchmark against their compensated, which they're compensated. Peer benchmarks induce theoretically as well as empirically, we show greater effort. Okay, it is true that they also may attract better managers. Okay, we cannot negate that, and we don't test for that explicitly. We control for the manager tenure, for instance, and our results remain there. Okay, we also show that there is not much differences a long time. It's more a cross-sectional variation in the contrast than a time series. These are inconsistent or less likely to be the outcome of a screening model. So we believe it is rather incentives. Okay, but we don't test for that explicitly, just to be honest. Okay, more skill, greater effort goes into more active management and superior net performance. Part of it is passed on to the investors. So net of fees, these guys performed with peer-based compensation also outperform. Okay, and it seems to be related to investor sophistication and family incentive structures. Policy implications. Well, the SEC actually should qualify this idea of limiting or just banning the disclosure of peers performance to investors. It seems like a valid, actually, piece of information. So it is true, they may be gaming, but this is something that there are, we show here actually incentives, or we show here arguments as to why peer-based compensation should be disclosed explicitly in the prospectuses. And that's it. Thank you very much for this opportunity, and happy to receive questions and comments.
Okay, thank you very much, Juan Pedro. I have a short number of questions. Not surprisingly, those directed to Patricia and Amra are basically directed to, again, to the how you do it or how you cope with a number of things. And those directed to Maria and Juan Pedro have more to do with the specific things in your models or conclusions. But before I address any of these questions, I think it would be fair for me to give the 4 speakers today an opportunity to ask each other questions or react to issues that the others have put forward. So if there is any of you that would like to take the floor for a second, please.
I had one question actually for Juan Pedro, which is, I can absolutely see why this would be the case, but does it also lead to greater herding? So if you look at the behavior of the funds in a crisis, do these funds actually fare worse? So over the long term, maybe they have higher returns, but you lose more in more severe periods. That's my question.
Thank you, Patricia. Very interesting question. So we cannot answer that because we have too short sample. So I cannot empirically answer your question, but I see actually what you're mentioning. So there is evidence that in terms of crisis, there tends to be more herding. So it will be interesting to see whether different kind of benchmarks actually are more successful, in avoiding that, right? We show that unconditional to crisis, the use of peer-based compensation leads to higher active management, which will be consistent with less herding. So you have more incentives to deviate from the benchmark. Whether that is true or how that is qualified in periods of crisis relative in periods of booms, that is something that I cannot answer with the data that we have. But unconditionally, comparing between peer and pure, if you want the manager to be more active and to be less likely closeted, passive, that would be with a peer one.
Yeah, I can see that. It's just that they may have incentives to try and track the peers. If you're in a sailing race and you need to beat boat X, you tend to track that boat quite closely in case they get a wind shift out there. So I just wondered if that would give this herding. Anyway, but I think it's a really interesting paper. Yeah.
Thank you, Patricia.
Actually, Patricia, I now hearing the question you put, I was wondering whether this would be one of the underlying reasons why the SEC was reluctant to let peer benchmarking be disclosed.
It may be, but from the reading of the discussion that was going on, it looks to me rather, which is a legitimate concern, I'm not saying that there's not a point in that, is that there may be gaming in the choice of the peers, right? So if you want to make your manager look better and make it easy for the manager to actually surpass the hurdle and earn the bonus, just choose peers that perform worse, right? So that is, one legitimate reason, which also accrues, it's a pertinent issue in CEO compensation. That is my feeling from reading the discussion previous to 93 to this law.
Any other reactions from panelists?
Can I ask also something to Juan Pedro?
Sure.
So my question is, so how can it be that the incentives of the company or the asset manager and the incentives of the guys that are actually managing the fund end up being so completely different. Because, there is this regulatory view that you pay on assets under manager to reduce risk, but this looks like very naive in view of what you showed us. So would it be better for the regulator to forget about this? Or is this just a pause? Or, what?
Well, we observed, we observed discrepancies because there is this limitation, right? So we go back to the discussion we just had. What are the reasons for the SEC to limit the benchmark in the prospectus to be only of the pure type? Okay, there may be reasons against and in favor, gaming, or maybe preventing healthy behavior, as discussed. Maybe one of the reasons in favor. Think about our contribution as saying, there may be other reasons in light of what we find in an unconstrained setting. So if you go to portfolio managers, that is unconstrained. There's no restriction. Actually, I know that because we wrote to the SEC to make this sure. There is no restriction as to how companies may design the incentives of their portfolio managers. So if there was no restriction, probably, but this is only a guess, we could see prospectus benchmarks to be more aligned, what is disclosed, with what they actually is used for the individual portfolio managers, right? So the discrepancy arises, and this is just my first reaction, because of the constraint. And I say this because what we observe in an unconstrained setting, where there is no regulatory constraint as to how the portfolio, how not just the benchmark, but any feature of the contract should be designed. And actually there we observe, convex contracts, or we rarely observe any mention to fulcrum contracts, okay, which is the type that the SEC also, for instance, establishes. And we observe that the benchmark is both pure and pure, okay? So if anything, is just, we don't observe, we observe discrepancies because of the constraints introduced by the SEC. Is there a reason for that? Well, this is a food for thought, right? This is what we are contributing to. I hope.
Any more questions? Well, otherwise I will just, now turn to Amra and Patricia, and there is a sort of a general question that I'm afraid will have an impossible answer or very hard answer. It has to do with the practice. You both in different aspects, you, Patricia, in boards themselves, and you, Amra, just as a force in stewardship in boards, have very difficult decisions to make, which are based in a number of priorities, goals, imposition, regulations. The question is, how do you go about, or what is the relative importance you assign to, first, the goals, the priorities of your stakeholders, or what could be seen as authorities or regulators' impositions, or third, the results of research like the ones we are seeing here. All of them necessary, but at the same time, in many cases, it might be contradictory, right? Some of them seen as, well-intentioned, as Maria said, all for the people, but without the people, or things that are basically based on what might be seen as very short-term or very narrow preferences by some of stakeholders. So how do you go about, establishing priorities or setting your way within this very difficult avenue to move in?
So, Patricia, if you don't mind me starting first, because I actually have a hard stop in about 4 minutes.
No, you start.
So look, I think the questions are spot on, because there is a long list of items that both investors and companies are being asked to solve. It's something that we spend a considerable amount of time talking to companies about, talking first and foremost with our clients what is on their mind. Regulation and policy is something clearly that we expect companies to comply with. But there is a lot that goes beyond what is required by law and regulation that the companies can do themselves. And this kind of market organic change and growth is the space that we often spend time talking to companies about, particularly when it comes to transparency and disclosure, which is so important for us, because that is how we make our own decisions, and that's what we based our own views and form our own views on. So when it comes to our priorities, we really spend a lot of time as an organization, not just within my own team, but with our fundamental active equities, our research teams, our sustainable investing team, spending a lot of time scanning horizon. We are looking at issues that are coming our way, issues that are emerging. 2 or 3 years ago, we now said very publicly that that climate risk is an investment risk, that we ourselves need to accelerate in our own efforts in how to address and how to work with companies, but fundamentally how to address this risk in the portfolios and assets that we manage on behalf of asset owners who are basically the true owners of companies that we invest in. It's not easy, absolutely. Priorities are only, the list of items is only getting longer, but one has to be very careful in trying to solve for absolutely everything. As an investor, we are fiduciary acting on behalf of asset owners, and that's fundamentally what's driving our priorities and what's driving our views. And the topics that I've described early on are really the topics that we believe can and will, in some shape or form, influence how companies evolve and what they do. And therefore, performance for basically at a company level, but also performance for our clients. So I hope that gives you some answer. I'm sorry that I have to jump off now, but very interesting conversation. And Patricia, I'm not sure that I'll have a chance to hear yours completely, but I'll just say goodbye here and I'll drop off in a minute. But I want to give at least Patricia here part of your answer. I look forward to it. Thank you. Thanks for inviting me.
Thank you. Thank you.
Well, it is tricky. I mean, you are working within a regulatory environment if you are a regulated firm. Some of the regulations, as I mentioned, will be very explicit, and on the structure of regulation of remuneration, and you have to make sure that you abide by them. The vaguer ones that they've come out with on culture, on diversity, and so on, I think sit with what the companies are trying to do anyway. The companies are thinking about the wider stakeholders, not just the shareholders, but their customers. They're thinking about their reputation, their profitability, their long-term sustainability. And if you're thinking about, and society, so if you're thinking about your reputation, you're thinking about society, then things like diversity, ESG are really important. That's why you need to have targets. But then you have to also weigh up, well, what does that do to your profitability? How do you get to the long term? What are these short-term goals? So I think it is actually weighing up things in the round as a board. You can't just be focused on your profitability. You've got to think about your social obligations. You've got to think about how you're going to be viewed by your customers. You've got to be able to think about how your reputation would be affected if you were lagging your peers, to get back to the previous paper. So I think it is just weighing up these things in the round. But at the moment, I don't think there's a conflict in terms of the vaguer aspirations between the regulations, the regulators, and what boards are trying to achieve on diversity and culture, and in the future probably also on ESG.
Thank you. I mean, before I go to the last batch of questions for Maria and maybe Juan Pedro. Juan Pedro, you got already a number of questions, so I don't know whether I'll have time to ask you more questions, but I just one very short question to you, Patricia. I don't know whether Amra is there. No, considering that we are talking in general about large firms or sort of semi-large firms, because they are the ones in which there is more outside investment, where you can exert some influence. They are representative, quoted firms, etc. But considering the large amount of population employed or product generated by small to medium firms, which follow somehow outside the scope of what you guys do, do you have any wish that do you have any hope that what you are doing will eventually extend to those firms which constitute such an important part of the population?
I guess it is harder for some of the smaller firms. Some of the financial pressures that they're trying to manage could be more intense in the short term. But they too must be weighing up quite carefully, I think, the effect of what they're doing, what they're incentivizing on their employees, their customers, the reputation of the firm. So in that sense, I don't think it's necessarily different. They don't have, well, they will have shareholders that aren't necessarily just family shareholders. So they're weighing things up. Now, they probably don't use balanced scorecards and incentive structures for individuals quite in the same way, but they will be trying to think about how they balance things through their targets, I should think. And I thought that the paper on the Swedish employment law and the effect of employees on the boards, and I could see that playing through actually in the small firms. And I think in the small firms, they probably are trying to think about the employee base actually quite intensively in their markets. I guess it manifests itself rather differently though in the incentive structures that they're looking at. But my goodness, I think any firm has to think about the incentive structures that they're setting for the management and the employees. I guess it's just more hands-on. With the smaller firms, the board and the management is much closer, of course.
Hey, thank you. Actually, you gave me the opportunity to pass on to the next question, which is for Maria. Maria, a challenging question about the setup of your research. I mean, your institutional setting exploits a law that applies to all firms in the country, and you are looking at small firms that mainly compete among themselves. But considering larger firms, would a given country have an incentive to strengthen employee bargaining in a global competitive environment where competitors pay lower salaries and offer lower prices? Because what you say is, it might be very good if you look at the closed economy, which is small, etc., etc. But when you look at this broad environment,
well, yeah, I think this is actually the problem that we are seeing, with this climate change and all of this, that, yes, so Europe may be very keen on, implementing these issues, but when you are facing global competition, then, and in other parts of the world, they will not pay attention to these issues. What happens? So actually, I think, it all boils down to there is a redistribution, okay, of gains, and this will work as long as people are willing to accept lower gains for themselves if there are, total gains that compensate this somewhere else. So, I think this boils down to how much we internalize, global welfare, and yeah, and into your value function, yes. So maybe we are still too far from that objective, and nothing can be done. So yeah, we'll see.
Okay. It's a question of wait and hope, right?
Yeah.
Anyway, listen, I guess we are a bit already past the time, but I still would like to put a question to Juan Pedro. Last question. Again, based on your results, I would say, if peer-based benchmarks are superior to benchmarks based on a broad index, why do you think they are used at all? I mean, and what would the policy implications of those findings be?
Yeah, thank you. Well, that's a good question, actually, but that's a good question for another paper, right? So in the model, we don't model the choice of the benchmark, right? But there must be some friction, right? So there must be some costs that prevent certain. I would say, one interesting finding is that the choice of the benchmark, as many other features in the contract, are not so much related to the specific fund as to the family. So what determines ultimately the features of the contract, including the benchmark, is the family rather than the fund. So there are certain families which prefer to use peer than peer. So that is the way probably to think in terms of what is driving the choice and what is the potentially the hidden costs in using peer-based compensation. Think about, naturally, for instance, and borrowing also from the CEO literature. If you're thinking about a very niche fund, okay, a fund investing in very obscure, small, emerging market securities, the problem is that there are not going to be many good peers, right? There are not going to be many peers to begin with. So that would be actually a limitation that makes peer-based compensation costly, okay, and noisy too, because there is not actually a good set of peers among which you can choose, and then therefore choose one which is really close to your strategy. So being alone in that kind of category, or having a category which is very niche, would be naturally one way to think about why it is costly to use peer-based compensation. So just short answer, there must be some cost in using peer-based compensation that we do not model explicitly that prevent certain families rather than funds from using this in principle or in theory, as we show, more efficient way of compensating managers.
Okay, well, thank you very much. First of all, panelists, José Manuel Campa, Jordi Gual, thank you. I've seen you all have stayed through the whole session today. We appreciate that. It's been an enormously challenging and a lot of food for thought that we got today from both sides, the practitioners and the academic side. I also thank the audience for having been with us for this very interesting session. Thank you very much, everybody today. We really appreciate your thoughts, your contribution, and your time. Thank you.